The Great Melt-Up. What Fed rate cuts mean for the common man. The Great Melt-Up describes a phase where asset markets, stocks, gold, and crypto soar, often fueled by loose monetary policy like Federal Reserve rate cuts. For the ultra-wealthy and seasoned investors, this is boom time. For the average working American, however, the consequences are a mixed bag of short-term relief and long-term financial peril. This isn't just market news, it's a policy that directly impacts grocery bills, housing affordability, and job security. Inflation's invisible tax on paychecks. The primary consequence of Fed rate cuts is the injection of cheap money into the economy, creating inflationary pressure. This policy acts as an invisible tax on the common man's earnings. The cost of living soars. While the stock market celebrates, the everyday consumer faces higher prices at the gas pump and the supermarket. Inflation disproportionately hurts low to middle-income families who spend a larger percentage of their earnings on necessities like food and rent. Their paycheck buys less and less each month. Savers and retirees are penalized. Rate cuts crush the returns on safe investments like savings accounts and CDs. Retirees who rely on fixed income see the purchasing power of their nest egg eroded by inflation while their savings earn virtually nothing. They are forced to take on greater risk just to keep pace. The Fed is essentially rewarding speculation and punishing fiscal prudence. The widening wealth gap and housing crisis. Melt-up accelerates wealth inequality because the gains are concentrated among those who own significant assets. Wages. The biggest beneficiaries are investors in stocks and non-productive assets like Bitcoin and gold. The average worker, whose primary asset is their labor and home equity, sees their wages lag far behind the growth of the financial markets. The housing affordability trap. While rate cuts can lower mortgage rates, they also dramatically drive up housing demand and prices. This creates an affordability crisis, pushing the dream of homeownership further out of reach for young families and first-time buyers. The Fed's policy inadvertently penalizes stability and rewards high-leverage borrowing. 3. Financial instability and job risk. A market rally fueled by cheap money is often unsustainable and breeds systemic risk. The melt-up increases the risk of an inevitable meltdown. The boom-bust cycle. Unchecked asset price growth often leads to bubbles. When the market corrects or the economy finally slows, the resulting recession is often sharper. This leads to widespread job losses and business closures. The worker who never invested $1 in Bitcoin still bears the ultimate cost through unemployment and decreased economic opportunity. Erosion of stability. The common man needs a predictable, stable economy to plan their life, saving for college, planning a career, or securing retirement. A policy that promotes short-term volatility and financial euphoria introduces unnecessary uncertainty, making sound personal financial planning far more precarious. Conclusion. The cost of easy money. Fed rate cuts meant to spur growth and fuel the financial markets come at a steep cost to the non-investing public. The Great Melt-Up is, for most people, a wealth transfer that accelerates inflation, worsens the housing crisis, and threatens long-term job security. The momentary excitement of surging asset prices is a poor substitute for the financial stability and security the average family needs to thrive.